Good night, everyone. I'm so good to be here with everyone. It's been a while since we've done one of these. So I'm Tania Tetrault, an advisor with Canaccord Genuity and the Tetrault Wealth Advisory Group, and I've got my business partner and portfolio manager, Rob, and my brother as well. So that's going to make it extra fun today that we get to chat about all of this stuff, and hopefully we'll get some questions from our viewers, our listeners today. But otherwise, we're going to chat about the markets. We're going to chat about what's going on with the markets over this past week. We're also going to see if we can answer any questions that both our clients as well as our other viewers have today. So let's get started. Rob, how are you doing these days? It's been a little bit, how should I say, frigid?
Are you talking about, the temperature in Winnipeg, I would imagine?
I'm talking about the actual weather today.
What are we, 80 years old? Yeah, no, for sure. It's cold. It's ridiculously cold. I was outside earlier shoveling my kids' rink. I should say my rink. We have a rink in the back, and I couldn't do the whole thing. First off, there was like 1.5 feet of snow. I don't know when that hit. And second of all, it was so cold. So I had the kids out there, their little shovels. I had my big shovel. We're all trying to clean the rink, and we got most of it done. But yeah, it's freezing out there. So I'm doing great, but I mean, it's January in Winnipeg.
Well, you can laugh at me and pretend that I'm 80 years old talking about the weather, but that's often one thing that we get to connect with people on, because now we're talking to everyone over Zoom on these video chat meetings. So at the very least, we can talk about the things we have in common. So let's talk about maybe some other things that we've got in common. So what's the big news that we're seeing this week?
First off, I actually don't think it's big news. I don't know how you feel, Tanya, but like for me, I guess I've been through too many of these, and I guess I've become jaded over time. But for me, this is like, you come to expect these, right? Like we sent a note to clients, I think it was yesterday or before yesterday, basically saying there's one of these every year, give or take. There's about one every year. Sometimes there's two a year. Sometimes there's none for 24 months. A movement of 10 or 15% in the market, we kind of see that regularly. And if you come to think that it's not going to happen, that's when you get complacent. But I just know they're going to hit, and they're going to hit again and again. And for us, it's just a matter of doing our job and making sure we're agnostic to emotion. And so, I mean, for me, and this sucks to hear maybe for you viewers out there, but I'm completely agnostic to this. And I really, I'm not impacted in any way by the movement in the market. And some people think that's odd or almost unnatural, but for me, that's how it is. How about you?
Well, part of it, I think, is that we've been a little bit spoiled the last couple of years for sure. And so you get used to it, right? You kind of start coasting, and you get used to, not really you hear so much on the news about, other things, the pandemic and politics. And, we really haven't heard too much in the last couple of years. And now it seems as though, any given day, of course, you're always going to have both ends of the spectrum. You're always going to have, the doomsayers, and you're always going to have, someone who thinks that the rally is going to continue, or we have another one coming soon. So you're right. I mean, this is par for the course in our business, in our industry for sure. But what
you actually, you can't have a market. You actually can't have a market if you don't have doomsdayers and buy everything because everything's so cheap. If you wouldn't have those two sides, the market would be inefficient. The proof that the market works is that every day you can open up BNN or CNBC, and you can see individuals that are saying it's the end of the world and you need to sell all your stocks and put it under your mattress. And there's people that are saying this is the cheapest stocks I've ever been, and so you need to go and buy them. And that's why we have an efficient market, which is one of the things I really love about it.
Okay, so let's then take a step back, because we talked about maybe taking emotion out of it. So what were the actual numbers this week? What did we actually see?
So Monday, Tuesday, today's Tuesday. So Monday, the last 2 days, we saw the two biggest intraday reversals of the NASDAQ, and I believe the Dow, points-wise, ever, back-to-back days. So, we saw 1,000 points on the Dow reverse itself twice. So in other words, you're down 1,000 points and you reverse that and you finish positive. And then NASDAQ didn't finish positive. NASDAQ got hammered today, but I mean, it was down 700 points at some point. So those reversals are really, really how we know that there's volatility and there's uncertainty. So those were two big numbers that hit yesterday. Tomorrow is the bigger number, though. Tomorrow is the Bank of Canada, the US Fed. They're going to talk about interest rates. And, there's a lot of people thinking that the Fed will tighten, if you will. So they've already announced they're pulling back capital. So that's one thing that we're watching. Inflation numbers came out recently, 7% year over year inflation. That scares people. So you have all these kind of forces that are causing fear. You got the overseas geopolitical tension in Ukraine, and then you have the other side, which is strong earnings. Omicron's finishing. We have a really good situation to buy stock because multiples have come down. You have no real buying power for bonds, so therefore cash has to go somewhere. So all these it's a dichotomy right now, which is why we're seeing big shifts. So markets get hammered, buyers come in and say, wow, I can buy this stock for 5% less than I could 1 hour ago, right? That's how much we saw move. We saw 5% moves in half a day. So I think you're seeing those two dichotomies, and they're badly.
So what do you think, investors out there, regular Canadian investors, how would you kind of filter the news right now? Because, you know that our clients kind of, talk to us a lot when they, they hear things on the news. And oftentimes what I find is that, what we're hearing on the news, we kind of imagine that this is going to have this huge impact on our portfolios. How should we go about kind of filtering that? And how should we also go about thinking about the impact that is actually going to have on our portfolio? I have a follow-up question for this as well. So we'll see if you get to kind of where I'm asking with this too.
So I think the quick answer is, if it's not going to impact your wealth in the immediate future, in that you're not speculating short-term, you don't have an immediate liquidity need, you don't need to, put a down payment on a house next week and you've got all your money in stocks, this really should be noise. It should really be noise, because 10% moves, they happen kind of all the time. So I know you're tempted, and you should follow the news. Absolutely. You should be educating yourself, reading, and you should be following the news. But to go from that to actually making impactful decisions in your portfolio, I think are two totally separate things. I think you should follow the news. I think you should be informed. I think you should read the stuff that we send out. I think you should, consume, if that's the right word, our content on our YouTube channels. And by the way, subscribe, like, follow, do all that fun stuff. I think you should do all that. But I think I actually don't think it's healthy for you to be making decisions, impactful decisions on your wealth at times where nothing's really changed in your life in terms of your wealth, your plan, your expected date of retirement, your cash flow, your income, your T4, your dependent situation, your marital situation. If none of that changes and there is a plan in place to make sure you're retiring or you're spending the money you need to retire, who cares if, I get that it's not great that there's geopolitical risk. That's not what I'm trying to minimize, but I'm just saying, who cares if for your portfolio and for your wealth, if there's a global event overseas? That's a long answer, but I don't know if that's what you're looking for.
Yeah, that's actually exactly what I was looking for. And then the follow-up then becomes, I think sometimes what we do is we sometimes have the tendency just emotionally to kind of amplify a number or a piece of news that we hear and try and assume that it's going to, we catastrophize and we assume that it's going to maybe affect our entire portfolio. But, when you and I kind of are looking at a portfolio, one of the things that we're going to look at when we design it and when we build it is going to be, what are the ways that we can protect or essentially, design the portfolio to minimize the volatility or the downside. So what I was thinking of, because we were just discussing this the other day, is that is just how important the asset allocation is and how much that will dampen the effect of even of corrections like this. So when we look at a portfolio, we might say, hey, okay, NASDAQ was down whatever it was, 12% this month or whatever that number was. And right away, you might catastrophize and you might start thinking, oh no, what if this stock is down 12% or whatever? But I would encourage people to think about it as a whole as well, because once you actually look at the asset allocation, you look at all the diversification. If your portfolio manager is doing their job with diversification, with proper asset allocation, then that impact will be lessened significantly. So I just wanted to touch on that a little bit, because I've been hearing a lot of people thinking, oh, markets are down 10%, so I guess I've lost 10% of my portfolio, right?
Yeah, catastrophize?
I don't know if I pronounced that correctly or not.
I've heard catastrophize. I've not heard that word in years, and I've heard it twice now from you today. I think that's what my daughters do when there's a Lego piece missing, or there's a Barbie appendage missing on one of their Barbies, it's the end of the world. And you're right. I don't think this is. Now, we will go through, to be clear, we will go through today what's actually happening with interest rates and inflation. But I do love this setup question, Tanya, because I think it's fantastic in that if you own nothing but the NASDAQ in your portfolio, yeah, you're probably down 15% or 12% or something like that this year. And worse, if you own nothing but NASDAQ, you probably have a whole whack of speculative stuff that's down 30, 40, 50, 60%. You probably have some crypto. So you're probably really getting hurt bad. And you're not our client, that's for sure, because we don't do that. We don't believe in that. So hopefully, you've not loaded up on one asset class, one specific asset class in your life. And I mean, if you own Canadian banks, they're boring as heck, but they're up this year. And if you own, alternative asset classes, private real estate, private infrastructure, private debt, all of those are up this year. So you're right. Clients think I'm down 15%. They're not. We looked at most of our clients and they're down, some are down 2, 3, 4%. So, they're not down 15% this month. So that's a good question.
Yeah. The other point I think that might be a good distinction, I guess, to make would be the distinction between volatility and actual losses, because you said it just now. Unless you actually need to liquidate your portfolio today to buy a new house or whatever that happens to be, what you are experiencing now is simply volatility and not and not an actual realized loss or anything like that too.
Or risk, right? People
or risk, exactly.
Volatility and risk. They'll say, oh my God, I have such a risky portfolio. I was down, 10% for a portion of my assets. You might be, right? Because I mean, even Google and Walmart and Home Depot are down 10% or more. So, I mean, would we consider those risky assets, risky asset classes? My definition of risk, I mean, risk is a whole other debate, but short term, we could say the definition of risk can be, for a quick answer, the likelihood of you actually, losing an asset class, or an asset class going to zero, or being a capital loss on an asset class. Or by volatility is the fact that if you own stocks, they're going to go up, they're going to go down. So we expect volatility. We don't expect risk of losses in our portfolio, how we build portfolios. We'd be surprised and devastated if a piece of our portfolio went to zero, because that's never happened, and we don't want it to happen.
Yeah, that's a good point. Looks like we have a question. Looks like we have our first question of the night from Randall. So, asset allocation is not the only way to dampen risk. What other tools would you consider appropriate? Tail hedge, puts, gold? Oh, that's a great question.
First of all, I just won $20 with Derek because I bet him that Randy Commission would have the first question today. So I'm up $20. Thank you for tuning in, Randy. I appreciate that. This is a good question. So for most people, we don't want to get into hedges. We don't want to get into, I forget what the 3 suggestions were. I think one was tail hedge, puts, and gold. So we definitely don't want to do tail hedges and puts. The liquidity that you can get and the volume and the expected work to do that is likely not the return. And plus, you're giving up a ton of upside. The gold, pure gold as a hedge, it's not something we believe in. I know a lot of portfolio managers have done this. And Tanya, you and I, we've never done that. We've never bought gold as an asset class. We have bought gold producers, right? Because they're profitable, and we hope that if gold goes up, their bottom line improves. So we wouldn't do that. I think to actually properly hedge, I forget what the question was, inflation or interest rates? Was it, sorry, producer Mox?
Just dampening risk in general.
Risk. Yeah. So our big view on dampening risk, and the reason we're winning awards nationally, is because we don't just focus on stocks and bonds. We focus on alternative assets. If you've been following me and Tanya for a while here, you know that that's how we preach and that's how we manage money. And that's why if you have an asset class that's totally uncorrelated to the market, or in fact has a reverse correlation to the market, generates positive returns even in a down market, that does wonders for your risk-adjusted return. And you can actually, so imagine having 30% of your portfolio that is totally unimpacted by the stock market. Well, now instead of being down 15%, you got that 1/3 of your portfolio that didn't get touched. So even if you had all the NASDAQ, you'd only be down 10, right? So, and on and on. So that's a big thing you do. The other things you could do is inside of your portfolio, you diversify geographically, Canada, US, globally. So Canada's doing well right now. So it's not as bad as the US. So that's good. And you diversify across different sectors. You don't just load up on tech or oil and gas or banks. You diversify. And then you make sure you have some value and some growth in your portfolio across management styles. So value would be stocks that are undervalued and represent a good a cheap price relative to what you would expect them to trade at. And then growth would be stocks that have tremendous potential for growth. So if you manage with all those factors in play, you actually dampen risk and reduce the volatility. Randy.
Yeah, great question, Randy. And I think actually this might be a good time to maybe talk about because we talked a little bit about hedging for just risk in general. Do we want to open up the discussion on inflation? Because I think now would be a good segue, because then we can talk a little bit about some of our favorite alternative asset classes that would be good inflation hedges. But let's talk a little bit about kind of what we're expecting to see and how that's going to impact everything.
Yeah, so inflation is definitely one of the bearish, we'll get to music royalties in a sec, but I just want to get this answer, Tania, for you here. So one of the bearish pressures on the market right now is definitely inflation. Like, it's probably the strongest, if not, it's a match between inflation and interest rates. Inflation, it erodes the potential future. It's an insidious force that erodes the potential future gains of your portfolio. If you're making 10%, but you got 7% inflation, you're only actually up 3% because your burger's costing you $1.07 and it only cost you $1 last year. So inflation is critical, and the companies that have long-term projected growth plays, like the Googles and the Amazons of the world, their tail end is 20, 25 years down the line. So if you have a ton of inflation, you're basically getting zero value to that earnings growth 20 and 25 years down the line. Hopefully, this is a tough one to understand, and hopefully I'm trying to explain that properly. But every year, you're eroding your purchasing power with inflation. If you're not getting the inflation lift on your stocks, that means you're actually getting a net return, which is less. So inflation hurts portfolios. So hopefully that makes a bit of sense with respect to inflation. Do you think I did a good job of explaining inflation?
I think so, Rob. But I think the other piece that I think we should talk about is how what types of either assets or companies would do a good job of not having inflation erode those profits. And then I think then we can contrast and compare the two and understand the difference a little bit better.
Yeah, so they used to, and experts and pundits would say that this is it's a momentary blip of inflation. And I even said that a few times early on in inflation. And it's clearly not, right? The $20 lunch is not going to go back to a $15 lunch. It's here to stay. The $110 Christmas tree or $120 Christmas tree, it's here to stay. So I do think inflation, the bump has happened. So that was 5, 6, now 7% year over year. I do think you could expect that to taper off and stabilize as. So I think to answer the question that'll likely come, what's our call on inflation? We do think it'll stabilize. Remember, when you're measuring inflation, you're measuring year over year. So we've had the bump, right? So we certainly don't think it'll be negative for sure, but the growth will likely be negative. So we'll probably go to 6 to 5 to 4, etc. Now, which companies do well in inflation? So one thing we really believe in is owning asset classes that can. So let's talk stocks real quick. So stocks that are good inflation hedges are stocks that they can pass on the inflation through their purchasing power and their brands to their consumers. So, I was on
simply
BNN,
charge more for their product or their service. Yeah.
Charge more. Yeah. I was on BNN and Andy Bell suggested Starbucks. And I kind of said, we don't own that stock, but that makes sense to me. It's a very strong brand. And, I don't want to debate its merit, the stock or not, but just the brand itself, if they go from, what's a Starbucks now? $8? I don't even know.
Yeah, whatever if it goes from $7.50 to $8, people are still going to buy the lattes, right?
Still going to buy your Starbucks. So that's a simple example, and I'm not trying to tell you guys to buy Starbucks. I'm just saying that's a simple example. The other one that we have in our portfolios is Walmart. Like if or in some of our portfolios, if the products at Walmart are more expensive because they're more expensive to source, you could be pretty darn sure you're going to pay more for them. So that's a simple example, and you want to look at stocks that can kind of protect themselves with purchasing power protection. The other one is owning a piece of CPI, which is the consumer price index. And the biggest piece of CPI is consumer price index, which is the year-to-year increase in cost of goods, CPI, is rent or housing cost, right? Housing cost is a big increase, and that's what it's about 30%. So if we could own the other side of that trade, and I spoke about this on BNN and it was in the link, I don't want to beat this horse to death, but private real estate, multifamily real estate, you own the rentals so that you can charge more on your rents.
Perfect. And I think that kind of helps us to wrap our head around a little bit, like why we've chosen, these types of, I guess you call them natural hedges, right, for the portfolios. So another asset class or another type of investment that might be that we would consider uncorrelated to the stock market would be music royalties. We can go back to Linda's question. Thanks for that question, Linda.
Hey, Linda.
So how are they doing?
Well, they've been doing really good, because what's happened, we work with ICM. It's a third-party manager through their Crescendo music royalty fund. So we get access through pension-style management of music royalties. They go out, they acquire catalogs of artists. So Taylor Swift, I believe they own. Anyways, other artists. I'm not going to pretend I do love music. Don't get me wrong. I love music, but I don't know the artists and I don't know their names and stuff. I like listening and I like kind of singing to myself and singing to my kids. I love music. I love the Beatles. I love Elvis, but I don't know all the names of these artists. Anyways, they go out and they acquire these catalogs, and there's predetermined deals in North America and Europe and Asia, etc., where every time a song is streamed, X many cents go to, every time an individual pays for a streaming service, or every time a song is put in a movie, a video game, a Peloton,
a YouTube video
here at my bike, a YouTube video, there's a streaming revenue that gets paid to the owner of that royalty, the owner of that product, the owner of that piece of the asset, I guess, the music asset.
It's intellectual property, I guess you could say.
Intellectual property. Yep. And I mean, if you're who sold recently? It was Neil Young. Yep. Neil Young sold a big chunk, and I forget what the number was, but what was my go-to, Rich? No, I'm not gonna. Well, I can share my go-to song. It was "Total Eclipse of the Heart." That was my number one song for karaoke. Rich Stramko, we lived together back in when I was doing my law school at the University of Toronto, and we used to. Rich could actually sing. I couldn't. But "Total Eclipse of the Heart" is what I sang. But where was I, Tanya? Sorry.
We're talking about music royalties and
music royalties. Oh yeah. Yes. So basically they have a deal where they collect that revenue, and what happens is, if you buy a catalog, it's going to get downloaded 30 million times, and you're going to get $30 million or whatever the number is, and you could predetermine what your cash flow is going to be for the future years. Now, if you happen to hit a catalog that has more streaming in future years, you end up getting an increase in revenue. And I mean, we haven't been with ICM a long time, but I know that they've increased their distribution and the NAV went up a little bit. So they're doing their job. Cash flow is increasing. The target range is kind of 8 to 10% with that. Now, it's completely classified as income. Think of it as a fixed income alternative. Now, it's much more volatile. It's a much more different asset class than bonds, less volatility because there's no day-to-day movement, but it's not, I wouldn't compare it to a bond, right? In that you own a royalty on an asset class. It's a little different, but it definitely has been doing what we wanted it to do in our clients' portfolios. The bearish view might be kind of 5 to 7%. The bullish view might be 10 to 13%. They're calling kind of 8 to 10, which is really good. Now, you don't want this necessarily all of your portfolio non-registered because of taxable consequences, but I think it's a really good investment asset class.
Yeah, and it does its job doing exactly what we were talking about, which is, reducing that volatility and essentially just being not correlated to the rest of the stock market, so that when we have a month like this, that still, trudges along and pays out the distribution. Oh, we got a question from Jimmy. Oh, thanks, Jimmy. Okay, so Jimmy's asking what our point of view on silver is.
So I kind of talked about this earlier with gold. We don't really have a differing view. Precious metals are all kind of, if my dad were here, he would say, I'll buy gold and silver when they pay me a dividend. In other words, he doesn't believe, and I guess I grew up around my dad, and we both grew up around our dad, Tanya, and our mom, I should say. But they would say stuff like this to us, and it's really impacted me. We did a ton of research on this, and we use Morgan Stanley's research at Canaccord. And again, we like to own companies that are profitable so that you don't have to rely on someone else paying you more for an asset class that you own today, right? So the only way you're making money with silver is someone's got to decide that your bar of silver is worth more a year from now than today. And that might happen. It very well might happen. It's just, for us, it's very impractical and difficult to forecast cash flow, especially if you have someone in retirement or someone that needs income. It doesn't suit our portfolio. So we'd rather own silver producers if we're going to own them, and not silver or gold or palladium or titanium or lithium or any of the precious metals.
Yeah, good answer. Oh, we've got another one already. All right, here we go. Our next one is, are Canadian banks still a buy at current prices?
So here's our view on Canadian banks, and this will sound boring, Steve, but I'm going to just say it. Our view is that you always have to own Canadian banks. You're always going to own Canadian banks if you're a client of ours. And, you might own a tad more sometimes and a tad less other times. My dad used to always say, when bank stocks are yielding 5 or 6%, you back up the truck, right? Because that means the price has fallen so much that the yield is so much higher that you will never go wrong if you buy bank stocks when they're yielding 6%. He used to always say that. And then you try to trim at 3% or 2.5%. And I don't think my dad's a genius, but I do think he's incredibly wise in the number of cycles that he's seen in his life, and he's right on this one. So if you're a client, you're always going to own Canadian banks. You should always be long Canadian banks. Now, if you have nothing right now, if you're cash and you're going into the market, so you sold a business, you inherited money or something, we would still recommend being long Canadian banks. So we would recommend buying some Canadian banks. Whether it's 20 or 25% of your Canadian equity exposure, Canadian financials can be Canadian banks. That's a reasonable number. It pays, especially if you have a non-registered account, the dividend is very favorable. So yes, we're definitely not loading up on Canadian banks. We're definitely not short. We're neutral right now, and we continue to own them, and we've always owned them.
All right, great answer. So I guess that would also be a good time to chat a little bit about kind of putting those two questions together, right? We talked a little bit about inflation. We talked about stocks. So if we continue to see, a lot of inflows and we continue to see a lot of inflation, could that actually mean that, the stocks could go even higher now at this particular point?
Yeah. So I think one of the key points that we're monitoring closely right now. So I talked about this earlier on, is the two opposing forces, opposing pressures right now. On one side, it's the negatives, which is interest rates, inflation, global, a pandemic, but also global events in Ukraine and stuff. But on the other side, just reminding your question, Tanya, was
is that with inflation and with with this dip and a lot of inflows into the equities market, people buying on the dip, could this kind of snowball even more?
Yeah, I think there's a couple of things. Definitely, whenever you get to oversold numbers and oversold emotion, you get buyers, and we've seen it the last 2 days. I will say this, the volatility is not over. Expect continued volatility for the next while here. And one thing we also know is that we don't know when it'll end. So expect continued volatility. But I also know that if you're buying quality assets and you're focusing on quality assets, you typically never, and you buy them at a 10 or 15% discount, you never really regret that. You might be wrong short term. You might be wrong for another month or 2 or 3 or 4, but you'll pretty much always be happy you bought that a year or 2 from now, because it's quality assets that will always make new all-time highs, right? So yes, we are oversold. The other point I think we should mention is, I think with inflation, typically whenever we get an announcement that inflation is coming, the end result is that you're able to, Credit Suisse actually, and we saw this on a note, they noted that over the past 4.5 months, stock prices rise 32 basis points on days when inflation expectations rise, and they actually fall on days when expectation. Now, why is that the case? I would imagine is that the market expects businesses to be able to pass that on to consumers, increase their growth, increase their earnings, and therefore increase their valuation. So you get that slight bump. So, inflation is obviously it is an insidious force, but it can be good for stocks, as Credit Suisse pointing out. And then inflows. So you talked about inflows. Mm-hmm. This was your question. So I think global equities and where else do you want to be right now? Can you be in bonds? Does anyone want to own a 10-year bond that's paying 1.65% or 7% and is likely to have 4 or 5 increases to the interest rates, which means your bond is going to fall in value and your face value of your bond is going to be less? And I can explain that if you guys want, but it's basically math. If you have a bond today that pays $1.75, it's a guaranteed obligation to pay me. I'm the holder of the bond. You're the emitter, Tanya. I give you $1,000, and every single 6 months you give me a coupon for me lending you money. Well, if interest rates go up, I can now buy a bond that's paying me 3%. Why would I want your bond that's paying me 1.75? I don't want it. Nobody wants it. So what happens is the price of the bond falls. So this is what's happened every time we've gone through a credit tightening cycle where interest rates start going up. Every single time over the last 20 years, you end up getting that depreciation in the value of bonds. The market is pricing in likelihood that the bonds are going to be worth less. And we saw it. We saw it in 2021 and we saw it in the beginning of this year. Bonds are not the place to be, unfortunately. So because bonds are not the place to be, individuals, they're kind of strapped, right? Like they want to get returns. They're retired. They need income. Where else can they go? They go to dividend paying stocks, or they used to go to growth stocks, but now they're kind of going back to value. We're seeing that shift right now. So dividend going stocks. So I think that is a point that you're making, that there could still be room to grow for stocks.
Mm-hmm. That's exactly it, because where else is it all going to go, right? But maybe we should also take a look at kind of the other side of the coin again. Maybe we're kind of flipping back and forth here again. What do you think about the valuations? And in general, kind of, are we still really stretched? Can you give me a little bit of your take on that?
So valuations are certainly at the high end of the historical range of valuation. So if you look at historical P to E, price to earnings, P/E, price to earnings ratios of, call it the S&P 500 or the TSX, they're at the high end range. Now they've come down a lot over the last month because, well, in order for PE, so for stocks to keep going up, one of two things have to happen. Either earnings have to go up or valuations have to go up. If you're at the top, if you've stretched out valuations as much as you can, the only way stock prices are going to go up is earnings growth. So I think the argument here would be, the argument would be if we can't stretch valuations anymore, well, where's the growth going to come from? So the argument to that, the bullish investor would say earnings growth. There's a ton of earnings growth. The pessimistic investor would say, not only are you not going to see earnings growth, you're going to see contraction on the multiples. Now, we don't think, sorry, I'm going to clear my throat, Tania. Give me 1 sec.
That's okay. So Rob is just, for now, talking about kind of valuation. So I know I've talked to some of our clients about this today. And, when we're looking at the prices and what we're, some projections, that's one of the key numbers, the key indicators that we're looking at, which is the price to earnings ratio, which is what Rob is just talking about right now.
Yeah, so the one argument I would make against saying that valuations are too high is that historical valuations weren't comparing cost of capital, which is one of the most expensive measures for a company, 10, 12, 14%. So what I'm saying now is companies have cheap cash. Companies have had the cheapest cash they've ever had in the history of humanity, I guess, give or take the last year or two. So because cash is so cheap, the argument goes that you can have higher multiples. You can have higher multiples for a couple of reasons. One, companies should trade at a higher multiple because that's one variable that is guaranteed to be cheap. And two, the same point I made earlier, you trade at a higher multiple when there's no other option. If it's the last bottle of water in the desert, like you could be a billionaire, but the millionaire is not getting that bottle of water, right? Like someone else is going to get that bottle of water. So now bonds are not quite the case, but you're not going to be buying bonds right now. So therefore, valuations can be higher. People are content to pay more for equities that are going to get a dividend yield and a little bit of growth. They'd rather get that than gamble owning a bond where they're probably going to get hammered when interest rates go up. So I know that's a lot to unwind there, but basically the negative, I'm kind of taking both sides of the arguments. Again, we continue to believe you have to own stocks. We are being defensive though. So you said valuations. I'm saying valuations are certainly stretched, but you could argue that it makes sense given where we're at in the world.
Okay, so, well, first of all, thanks, Nikad, for the comment. If you'd like us to talk about more about the lingo and the expressions, just let us know. And if you have any questions about the lingo or the acronyms or all of that, please just post it in the comments. We want your comments, the likes, the subscribes, all the social media stuff that I keep forgetting because I don't really know all of which ones are likes and which ones are subscribes and comments. But for sure, give us a comment, ask your questions. And
hey, you know what else we should do, Tania? We should ask the viewers if they want to know, personal questions about how it was to grow up with an older sister that was extremely mean to me, and kind of rule the house with an iron fist, and never let me do anything, and always oppressed me as a young child. Feel free to ask those questions as well, right?
Or if you want to learn what it's like to open up the path to your younger siblings and to break in your parents so that your younger siblings get to do whatever they want, and all the favors that you do for the youngest child, they can ask about that too.
I thought you were going to say, if you want to know what it's like to live with a guy who would, I don't know, and then you were going to take a cheap shot at me or something. No, I'm glad you didn't. You took the higher road.
I took the higher road. I opened it up all for you. You probably had the best teenagehood ever because of me, I would say.
I had a great teenagehood. It was so awesome. Grew up in Marchand, Manitoba. Older brother, older sister took care of me. Didn't have many neighbors and friends, so we had to play with you guys, my brother mostly. But it was just awesome. Just different era. I guess I was on the cusp of being a millennial. We didn't have much in terms of technology, no cell phones and stuff. Different era, but I would never trade. It was awesome.
Yeah, some of the best years ever. Yeah, amazing. Oh, now we're getting all nostalgic. Okay, so the next question we have here, and I was just going to bring this up because, Rob, you talked a little bit about, when we're buying a company, we really are buying it for the long haul. We're buying the company because we know it's going to be profitable, or we think it's going to be profitable. We think that there's going to be, a good cash flow prospect for the future. So tell me a little bit about, because I'm seeing a lot of articles here, and we hear a lot about Warren Buffett's strategy. And I think that fits in really, really well with, some aspects of our philosophy where, if we think that, we wouldn't want to own a company that goes down 10% during a correction, then we don't buy it at all. But if we think that the company is going to be, we're still going to want to have this in our portfolio in 10 or 15 or 20 or 50 years, then we buy it, right?
Yeah, and I think Warren Buffett is a deep value investor. He's always been a value investor. So he looks for companies that trade on a discount to their relative valuations, what they've traded at historically. And he doesn't look at anything as a stock. He looks at it as a company. So I know a lot of people that are watching this might be traders. And if you're a trader, you're not trading like Warren Buffett, and that's fine. You've chosen to do a different path, and that's what you want to do. But Warren Buffett would only buy a company that he wants to own, and he wants to own it permanently. There's an analogy where he used to think of a matchbook, and I think there were 10 or 20 matches in the analogy, and you can buy 20 companies, and then when you're done, you're done. You're out of match, but you're out of stamps. So you better make darn sure you're buying the absolute best companies you're ever going to buy, right? So he's a deep value investor. He's also aware that some companies might correct as much as 50%, and he says it as much. He said it as at their 2020 shareholder meeting. Be prepared for a stock to correct 50% if you own it. Yeah, and he also says, be careful of the news, right? So he's like, the news is noise, is what he says. Now, again, I'm not saying that you should never watch the news. He views that. What he looks at is balance sheet statements, income statements, projected cash flow, how much we're going to get long term. And he really, really thinks long term. Like, he's not ever thinking month over month or even quarter over quarter. He's thinking year over year over year. So I know that's tough. I know that's very, very tough for years. And for me, when I started investing, I could not wrap my head around how this guy was viewing 40 years down the line, but he's doing it. And I think he's been extremely successful at it. Also, he says, invest in what you know. So, and I often tell this to clients, like, if you're in, I don't know, if you're in you own a McDonald's or something, or you own a bunch of McDonald's stores and you really understand the quick service restaurant business, well, maybe you could invest in some of those businesses, the competitors, or maybe even McDonald's or whatever it may be, because you understand that business, you know the cash flow, you get the metrics. So that's something, invest in stuff you know or you want to follow, right? If you really want to follow closely Manchester United, and they're a publicly traded company, and that's your favorite football team or soccer team, whatever, buy the stock if you really like it and you think the valuation and the metrics make sense.
So how would that change? Oh, we've got another question here. We're going to leave it on the board because I want to just finish off your thought here about how Warren Buffett would. So would his strategy actually be any different in times of high volatility than in times of not so high volatility? Because that was actually the original question, and so I kind of want to hear your thoughts on that. Is that, would he actually change the strategy in high volatility?
He puts money to work. He puts money to work in value companies if there's an opportunity. Now, given that he's mostly a value guy and the value stocks have not been hurt a ton recently, he'd likely be. He's also notoriously slow to move. Notoriously, he sat on 200 billion in cash for an extended period of time. So he's notoriously slow to move. So he's not in a hurry to pull the trigger. He wants to buy quality. So in volatile times, he's not going to be panic trading. He's going to take his time, and he has to take large positions, right? Because Berkshire Hathaway's market cap is so large. The value of the company is so large. He has to take very large positions. So it's not like you and I buying 200 shares of Google, right? He's buying like millions and millions and millions of shares. So in volatile times, he looks for opportunity. He definitely looks. He's a bottom feeder. He likes to, I don't know if that's the right term. No, he looks for deals. Let's put it that way. He looks for deals.
An opportunity seeker.
Opportunity seeker. And then when markets are high, he's been known to actually trim some positions. So in volatile times, he would look towards putting cash in the market, especially if it's a value correction.
Okay. Yeah, I like that. That was actually the original question. Now, our next one is, I love that we're getting into kind of a little more educational stuff here. So what's the difference between the TSX and the TSXV, the venture TSX?
Okay, so I know the big picture. The TSX is larger cap companies. It stands for the Toronto Stock Exchange. It's larger cap companies. There are minimums for shares traded, price of shares, volume. There's rules for the board. There's rules for transparency. It's more expensive. You need to file certain documents more often. It's kind of the senior exchange in Canada, the most well-respected. It's where the big players play. So that's the TSX. It's our largest exchange. If you have a publicly traded company and you want to trade in Canada, you want to migrate to the TSX. However, because it's expensive to get on the TSX, it's several hundred thousands of dollars, the fees and the accounting and the reporting. Someone decided, a capitalist decided to create an exchange that was for junior companies, the TSX Venture Exchange. TSXV stands for TSX Venture Exchange. It's for venture capital firms, companies, smaller companies, smaller market cap companies that are worth less, not worthless, worth less, worth a little bit less. So companies that might have, they just started out, they just kind of got their listing, and they don't want to have an impediment to being public, which is these rules and regulations that they have to meet, and they don't have that much capital. So less rules, more high flyers, a lot more volatility, less trading typically on the TSXV. So it's a junior exchange is a word to describe smaller companies, and they all want to kind of mature and grow up and eventually make their way to the TSX. There's also some other exchanges in Canada, the CSC. There's some other junior exchanges that exist as well that have different rules as well. But basically, different rules, different transparency regulations, somewhere for all companies to start.
All right. Thanks, Rob. Okay, here's our next one. When I pick a stock, do I have to check income statements, balance sheets, cash flow statements? How important is it for the end investor to check this?
Man,
shall we say it depends?
Well, I wouldn't. I unless you're extremely passionate about this, like I can't imagine viewers at home are actually going through balance sheet, cash flow statements, income statements for companies. Like I don't know how you would possibly do that for all the companies, and it takes a lot of time to review those. So I'd say no.
I'd say if you're our clients, you probably, we do that for you. If you're our clients,
yeah. I don't know why, like, I don't understand. Like, I love this stuff and I do it for a living, and it's, the thing I'm the most passionate about, probably one of the things I'm the most passionate about in life. It's just going to be so much work for you. And plus, okay, you've read the balance sheet and the cash flow statement, the income statement. Now what? Do you know how to interpret it? Do you know how to compare it to its peers? Do you know if it's a good buy? Do you know how management is doing? So I would obviously, I'm biased because we do this for clients for a living, right, Tania? So I want to tell you, M or U, that you should be working with someone like us. And if it's not us, someone else who does this for you that you trust and that you know are going to have your best interest at heart, are fiduciary. They're going to watch your back. They're going to manage your money like it's their own, and they're going to protect your capital. So that's what I want to tell you, because I can't imagine you're going to end out ahead trying to do this yourself.
Yeah, I would agree. However, I would also say, though, that if you don't have a portfolio manager, you certainly do need to do your research, whatever that research happens to be, right? So I would add that for sure. And then we had another question as well that was just on the screen before, and we'll get to the RSP loans after this. But Larkville was asking us, what do we look for when we look at all those things? So what do when we're looking at those documents?
It depends on the company. But clearly, if it's a mature company, you want to look at free cash flow or earnings, and you want to compare quarter over quarter, year over year. You want to see if there are patterns, certain quarters that are likely to be better than others. So you want to compare quarter over quarter, year over year. You also want to take a look at the capital, like how much capital they have, how much are they going to be short? Are they going to be able to meet their capex, their needs for expansions or for whatever that may be? Because what you don't want is a company that is going through a cycle where they need cash and then they can't actually raise the cash. They have to go to the markets and then they got to raise the cash. So if it's a mature company, and like, some of the Dow or the TSX 100 or the biggest companies in North America, you can get by with a pretty quick cursory analysis, looking at earnings per share, and then looking at where those earnings come from. And did that change a lot in the prior quarter? Is it still from the same revenue source? And at what rate it's growing? And then are there any scandals or anything happening in management? And if not, one of the neat stories, I'm doing my PhD in global business and leadership. And I had a case study this weekend, and it was on Mattel, the company. And they had a phenomenal quarter, but guess what? They sell a lot of toys. When do you think they might sell a lot of toys?
Holiday, Christmas, and holidays.
Yeah, their Q4 fiscal, or calendar Q3 fiscal, is by far their best quarter. So they were kind of touting it as a phenomenal quarter over quarter growth, but really, like, there's not a ton of growth year over year. So anyways, that kind of stuff you'd want to try to look into.
Yeah, and looking for scandals or kind of big changes in management or changes in how they run the business. Yeah. All right, our next one is from Dakota, wanting us to discuss RSP loans. Oh, did you have another comment?
I just want to add one more thing. Prior question. So also look at if there's any material write-offs or loan loss provisions that are impacting revenue. So are they putting aside a ton of capital for a potential problem, a potential loss? That is significant. You have to catch that if you're reading. So RSP loans, right?
Yeah, exactly.
Don't forget to subscribe, like, follow, share. We'd love to, we just passed 4,000 subscribers. By the way, I was telling my kids I was doing a YouTube live today. My son tells me, and my daughter, they're like, there's this Minecraft YouTuber, Papa, and he has like 3 million subscribers and you have 4,000. And I was like, I know, but I mean, I'm doing my best here. And then my daughter's like, there's this YouTuber that does these Elsa and Anya Barbie doll. They just play with the dolls. You should see these videos, Tania. I feel like I'm going crazy.
It's so funny that you say that. My son said the same thing.
They put the video out.
He said, do you have as many
like millions and millions?
I know. He asked me, actually, my 6-year-old asked me if we had as many followers as there's little girls with a YouTube channel that make like geographical maps with Play-Doh, and they have like 2 million subscribers for making maps with Play-Doh. And I had to tell him
we gotta figure this out.
Maybe we have to play with toys.
Play-Doh? I don't know. But so subscribe. Let's get to 1 million subscribers, please, just so my son can stay off my back. RSP loans. So typically, here's how an RSP loan works. So you don't have the capital to put all your money in your RSP by the deadline, and yet you have a very high taxable income, typically 50% taxable income, so above 200,000 of income. You would go to your bank and you would say, can you lend me my RSP contribution for this year, 28,000, 29,000, 30,000, whatever that number is. The bank would lend you 30,000 upfront in February, kind of now, and then you would make payments over the course of the next 12 months. Don't forget, you're going to get 15,000 of that back. So you take that 15,000, typically you would immediately give that back to the bank, and then you have small, $1,000 payments or whatever over the course of the next 12 months to erase that RSP loan. And what are you left with? You're left with $30,000 extra in your RSP that's compounded tax-free, and otherwise you would have not have been able to make that contribution. So it's great if you don't have the capital. I would suggest to try to plan better, and I know that's easier said than done, so I'm not chirping in any way, and I'm not going to walk a mile in your shoes, Dakota. I don't know what you're going through, but ideally you could try to plan for that ahead of time and put some money aside. But if you can't, it's a great way to get a ton of capital up front, put the deduction down, and pay it back over time.
I like it. Oh, good. Keep them coming. We got some more questions. Ooh, this one's from Ray from Toronto, who's asking us what we think of crypto.
So, crypto's not going away anytime soon. So there's going to be momentum behind buying in crypto. So I just said earlier that we don't buy gold and we don't buy silver. Crypto, you could argue, Rob, you're contradicting yourself, because crypto doesn't pay a dividend. Why would you own crypto if you don't own gold and silver? So the only reason that I would own crypto is because of the monster momentum that's behind it. And I would not necessarily recommend, and I've said this before, and I've said this on BNN, we think a max allocation for an extremely aggressive investor should be maybe 5%, something like that. If you're kind of an aggressive investor and you really want a piece of it, you can probably take 1 or 2 or 3% in your portfolio, maybe 4. Most balanced investors, if you're just kind of retired or you're approaching retirement and you don't really follow this and you don't really want the volatility, don't worry about it. You don't need any. You'll be fine. There are plenty of asset classes that can generate the same amount of return. Plus, it might drop 50% in 3 days, which we saw last week, or like in a week. I think we saw a 50% drop in crypto. I'm exaggerating, but it was very significant. You think the beta on growth stock? So beta is the amount of movement you get in an asset class relative to 1% movement of the S&P 500 or a benchmark. So if the S&P 500 moves 1%, the riskier stocks might have a beta of 1.5, right? So they move 1.5 times what the S&P 500. And the more conservative stocks, banks and industrials and stuff like that, they might have a beta of 0.7 or 0.6. They move less than the S&P 500. So crypto has an extremely high beta. It probably has a beta of 4 or 5, and that whenever you get big swings in the market, it amplifies these swings. So if you're not able to stomach that, it's not fun buying 100 grand of crypto and you look at it a month later and it's at 50 grand and you're like, what the heck just happened? Yeah, that happened. So I think my light just went out.
Yeah,
that's okay.
That's okay. What I was going to say too about that is, as long as, I think you really have to avoid the whole FOMO thing with crypto, because, if you're the kind of person who looks at your portfolio every day and you're worried about, a percent here or a percent there, I would say do not let, don't worry about that. Don't let, everything that you're hearing out there about, how much it went up and all of this. Don't let that fear of missing out affect you, because you're just going to be happy when it plunges 50% like it did, or whatever that number was in the last few weeks. You're just be happy that you didn't have it in your portfolio at that point, right?
Yeah, and that being said, I do believe that there's momentum coming in crypto. So I do believe there's a period of time here, a year or 2 or whatever it may be, not because fundamentally it's the greatest thing ever, not because the white paper on Ether is the best one ever, just because the buying pressure that's likely to come from institutional investors and everyone who hasn't been able to buy it yet. I do believe there's buying momentum likely to come over the next few years. And don't think of it as an asset class. Don't think of it as an investment. And I know that's hard to wrap your head around, but and it's got to fit your risk profile. So don't remember, I don't know your personal situation. So I'm not giving advice here. This is not advice. I'm saying you could consider an asset allocation.
Okay. I agree. And yeah, I would just say, don't buy it just because you're afraid of missing out on something.
That's the worst reason. That's the worst reason to buy stuff, because by the time you're buying it, you know what's happening? You've kind of capitulated and said, you know what? All right, enough's enough. I'm buying. And by that point, you're buying at the top. And then what's going to happen when it collapses 30, 40, or 50% is you're going to say, why was I in this in the first place? And you're going to sell at the bottom. It's the typical classical emotional behavioral psychology of investing. And we see it all the time. So don't buy for the wrong reasons.
Yeah, good answer. All right. Next question. Do we ever use options to hedge?
So I've answered this one earlier. No, it's not something we do. You could do it. It's just there's way too many problems in doing it. The liquidity in Canada, you're giving away upside. There's inefficiencies in the options market, in my view. I've seen too many things in the options market, and if my dad were here, not that he's a conspiracy theorist about options markets, but it's such a thinly traded market that a few players, like, you wouldn't think this, right? You think it's an extremely transparent market, but a few players can actually move the market and create inefficiencies. So it doesn't do, on paper it works. Trust me, on paper it works, but in reality, in our experience, it's not worth it for clients.
Yeah, we've found that we've done better with other kind of different ways of naturally hedging anyways. So that seems to work a little bit better. All right, we have a question from Guillermo.
I love this.
Guillermo, what should Guillermo do to stop looking at his portfolio every day?
Delete the app. Start with that. And I'm serious. Delete the app, because it's an easy way for you to look. You probably have an app or an online thing that you're looking at every day. Unless you're like needing a liquidity event or something, there's no reason to look at your portfolio every day. And I know some people enjoy doing it. And if you enjoy doing it, that's one thing. But if you get to the point where it's actually harming you, and I think Guillermo's at the point that it's impacting his life, it's kind of like Facebook, right? Like, if you're always on Facebook and you're messaging people and you're commenting on other people's cat pictures and you're like, I just need a break from Facebook. Well, delete the app from your phone, right? Take a break from Facebook. And I think it's the same thing with portfolios. I would start with that. Maybe have a discussion with your portfolio manager or your planner to make sure that you understand what your asset allocation is, what your potential downside is, and what your plan is for retirement or for cash flow. And if you actually properly understood your plan for retirement, I think, Guillermo, you'd be in a better shape, and you might go, you know what, I don't need to do this. We've been doing this for a while, and I can tell you a lot of people come to us with the look at their portfolio disease every day. And a lot of them have told me anecdotally that they've
Yes, awesome. Way to go, Guillermo.
Guillermo says he deleted the app. Good for you. A lot of them have told me that they've stopped looking at their portfolio every day because they're just in a position now where they've seen us manage their portfolios through 2 or 3 or 4 microcycles, and they're like, you know what? I've always come out on top, and like, my downside's not much. I trust these guys. They know what they're doing.
That's right.
I
got a couple of emails today, actually, of people who said, they just turned it on and deleted it because they knew that we were taking care of business. Guillermo, the other thing I would tell you is no use looking at something that you can't do anything about. So that's the other piece of it, right? If you can't control it, why are you wasting time, right? So there's that. All right.
Focus on the thing. 1 sec. So focus on the things you can control. Focus on the things you can't control. Use your energy. We only have so much energy and so much passion, so much life to give every single day on this planet. So if you're giving it on something you can't control, you're unfortunately just hurting yourself, stressing yourself, and leading to further illness or whatever down the line. Focus on the things you can control and do the best you can for those. Your portfolio you can't control unless there's an immediate event or something that's coming that you need. And again, after Tanya, I know we got a couple more questions. I do want to run through again just the bullish and the kind of the bearish talking points at the end, but I do want to answer Rich's question here.
Do you think we should go over a little bit if we need to after Rich's question here? Because we're coming up to 9 o'clock.
Yeah.
Okay.
Yeah. I mean, my kids could have a later bedtime, right? It's okay. I think.
All right. Well, let's do this. Let's do Rich's question, and then we can do kind of some highlights of the bearish and bullish points that we were looking at today. So let's do that first. Let's do Rich's question, which is, are we a fan of the Smith maneuver?
So the Smith maneuver is a way to effectively convert your mortgage into an interest loan so that you can write off the interest. So you're pulling money out, and it eventually becomes a home equity line, and every month you're shifting money, and then eventually all of your mortgage becomes a home equity line, which you could write off the interest. So provided you're in a situation where it's doable, provided you don't have liquidity needs, provided, yes, I am a fan, it can work. What we typically advise clients is to actually, generally the easiest way to do it is to do the lump sum shift. You do a lump sum shift on your mortgage through a home equity line, and then you just borrow back from it, and then you invest, and you have a direct trace of proceeds, and then you can write off the interest from your mortgage that way. So yes, I'm a fan, Rich. Not as much as I'm a fan of you singing. What was your go-to?
Total Eclipse of the Heart? No.
No, that was mine. Mine was definitely Total Eclipse of the Heart. Rich was more like, he was more versatile. He had a whole bunch of songs that he could sing.
I bet there was some Bon Jovi in there or something like that at the time.
Probably. Yeah, probably.
All right. So why don't we take a little bit of a step back here, because we did a little bit of back and forth today. We also answered, questions, but really kind of our main topic today, we were looking at various bullish views on the market versus bearish views on the market. So we covered kind of a few of the topics here. What did we not cover that we wanted to go over? So we didn't talk about the pandemic or Omicron. I thought, maybe we'll get through a whole hour without actually using the word pandemic.
Yeah, so we don't have to talk about it other than to say the strength of it is obviously the fact that we're ending. It's going to reopen at some point here. And, once 100% of people have had COVID, no, I don't know. I'm not going to get into this, but we're getting close to it. I feel like we're getting close to the end. So that's a positive. The negative is obviously the supply chain disruptions that came with Omicron, and that's impacting corporate earnings. So corporations are saying on every call now, supply chain. And that's largely been caused by Omicron, transportation issues, truck drivers not being able to bring materials, production lines being offline for extended periods of time. I don't know if you've noticed the grocery stores, like I know, Tanya, you probably don't go to grocery stores, but because you get that ordered in. But I went the other day and I was like, the shelves are bare. Like,
I know.
So
yeah, we've noticed that too. And when we order, groceries for delivery used to be a day, and now it's like 5 days for someone to go shopping for your groceries. So yeah.
What a great world we live in, though, right? Because that's hashtag first world problems. It takes me so long to get someone to deliver my groceries to my house.
Yeah, I can't believe I just said those words. They just came out of my mouth. Wow. Okay, so that's kind of the pro. So on the positive side, though, the Omicron, if this is a peak and if this becomes kind of if it's a milder variant and it's peaking, that could be.
Could be for sure a positive. Yeah. The other thing is earnings continue to be extremely solid, 20% plus growth. So the optimist would say, wow, that's unbelievable, 20% plus growth. The pessimist would say, yeah, but Rob, you need that growth to justify these valuations. So the moment you're not getting 20% plus growth, you're going to see a pullback. That's what the pessimist would say. So earnings are going to dictate a lot. This week is earnings season. So 50% of the S&P 500 companies are reporting earnings this week. Microsoft, Tesla tomorrow, Google next week, Monday, IBM, Boeing. Anyways, all the big companies are reporting this week, Visa, MasterCard. So this week and next week. So we're going to have a lot clearer picture of what earnings look like kind of in a week from now. And if earnings continue to be strong, that might be a bit of a catalyst to see some buying here. If earnings are weak, you might see more downward pressure here. And I know that's not what you want to hear if you're watching this show right now, because Rob's basically covering his butt and saying it might do this and it might do that. But one thing we know is that we don't know what's going to happen short term, right?
Okay. We didn't talk about the corporate buyback window. Goldman Sachs buyback desk. They're thinking that, the repurchases are looking big this year.
Yeah. They think $1 trillion, I think, something like that, right?
Mm-hmm. 975 billion. So yeah.
Yeah. So they're thinking $1 trillion of corporate buybacks. And we know what that means, or if we don't, I will explain it. What a corporate buyback is, it's a company buying its own shares into the market. In other words, they feel that their stocks are so undervalued that they're buying back their shares. Banks and financial companies, et cetera, were kind of restricted from doing this through the COVID pandemic because the governments wanted companies to shore up their financial balance sheets, et cetera. So you accumulate that cash. Don't worry about buying back. Now these companies have accumulated this cash. Really, there's only three things that could happen with that cash. They could pay a dividend out to the shareholders, special dividend. They could buy their shares back, or they could do a CapEx, a capital expenditure, and try to expand growth that way. Now, CapEx is tough to do in a pandemic, and they're not going to pay special dividends because it's not something that markets typically do. So you can expect to see a whole whack of companies buy their shares back to the tune of $1 trillion. What does that do? It leans up the number of shares. So it
dilutes. No.
Yeah, it's the opposite of it's the opposite of diluting. Oh my God, yes. I'm having a blank here. It's
concentrating, or that's not the right word, but
oh my God, yeah. Anyways, that word. And what it also does is it creates buying it creates buys in the market. Like that's $1 trillion of buys that have to happen. And whenever there's buying pressure, stocks go up, right? So, I mean, it's not a huge factor, but it's something we have to consider. And the other one I want to mention, Tanya, and I've had questions on this and you've had questions on this, is this whole geopolitical thing in Russia. And I don't want to minimize it. It's significant. People are dying and are being oppressed, and it's not a great thing. And I think it's terrible what's happening there. I don't know much about it, to be frank, and that's because these geopolitical events typically don't move the market ever or at all. So maybe we'll send a note this weekend to our clients about geopolitical events. So typically, we looked at the geopolitical events over the last 80 years, which includes like Iranian strikes, the North Korean missile crisis, the bombing of Syria, the London subway bombing, the U.S. terrorist attacks, the invasion of Kuwait, the Pearl Harbor, Yom Kippur War, the 60-day war. Anyways, all these
real
global
significant
these wars, yeah. And the drawdown ended up on average being about 6%, and typically it's like a month or so to get down, and a month or so to get back. So these are not significant events. The bigger macro events, if you think of all the crashes that have happened, 87, 2008, 2020, you can never say it's always this, right? It's usually one black swan event. 2020 was a global pandemic. 2008 was a financial crisis where banks couldn't meet payroll. 87, I mean, if Claude were here, he'd talk a lot more about 87 than I would. But again, these are black swan events that they're kind of like one-offs, and you always hear people say, well, that won't happen again, and that won't happen again, and we'll be ready for the next one. But I tell you what, the next crash, we're going to sit here and go, yeah, we didn't see that one coming, right? Yeah, 40%, just like that. Anyways, so I don't think the crash is coming from a geopolitical event, is what I'm saying.
It's interesting that you bring up the Black Swan event. That could be an interesting read for some of our viewers out there. Great book. Let's see what else. We were also looking. Okay, so should we flip the coin here over and talk about maybe the other side? So
the big one is tomorrow is the fiscal, the tightening of the balance sheets and interest rates. We'll find out. So the market is expecting 60% likelihood of Canada tightening their interest rates. US, it looks like they're not going to do it, but they're likely going to announce language to the effect that interest rate hikes are coming. So that scares the market. So if we actually do get a hike in Canada and the US, which I don't think is happening, I think it's quite possible in Canada, then you could expect a negative day tomorrow. The announcements are typically in the afternoon, if I'm not mistaken. I want to say 1:30 or something like that, or 12:30. So that's coming tomorrow, and that's what we're keeping an eye on for interest rates over the next, because we're expecting 4 interest rate hikes, in 4 or 5 in Canada over the next year and a bit, and or maybe even 6 in Canada and 4 or 5 in the US.
Okay, so we'll be watching for that tomorrow, later this week. See how that all plays out. Maybe in closing, shall we talk a little bit about where the fear and greed index is at and what that means?
Yeah, so I think this is a few days ago already, so I think we would need an updated one on this. But so fear greed index is basically it's a combination. I believe it's a Morgan Stanley index. I'm not sure, the one we use anyways. It covers a whole bunch of things, basically short selling. It takes a look at emotion, takes a look at consumer sentiment, buyer sentiment, home buyer numbers, all that, and takes a look at, are we being fearful or greedy right now? The index right now, you would think, is on the fear side, right? But it's actually rather neutral still. So that tells me that there's still a potential for further downside. Now, that being said, this is not a science, and we've been in situations where we're at extreme greed, and the market just keeps going for another 6 months, 8 months. And I guarantee you, in March 2020, it was at extreme fear way after the market was rallying. So these things are not direct science, but right now, it's about a neutral indicator right now.
I still like mentioning it because I think even just the terminology of it and how it's set up, I think it helps, potential investors just wrap their head around the impact, how markets work essentially, right? And how having, investors who are making these decisions, sometimes emotionally, how that impacts the market. So I kind of like looking, for me, I feel like it's a nice tool, I guess you could say. If anything, we'll just call it a tool, right?
Absolutely. I think if I'm going to say one last thing, it's just if you're a client of ours and you're watching this right now, I hope that you don't get the impression that we don't care about these downward markets. We definitely do. We just seen so many of them that we're perhaps, less emotional than you'd like us to be. We do care. Your portfolio is in good hands. We have a lot of alternative asset classes. We don't speculate in your portfolio. You don't own any stocks that are trading at 1,000,000 times earnings. So you don't have any of that. So we're incredibly confident with the position and we're ready to act. If there's cash in your portfolio, we're going to put that to work. If you have cash at home, you're sitting on cash, obviously give us a call, send us an email. We'd love to put that to work for you. And if you're not a client, I don't know what you're waiting for. Go to www.speaktorob.com. We'd love to book a no obligation consultation to chat about this or anything else that's on your mind. So I thank you guys for tuning in. And Tania, I will let you have the last word.
Thanks so much to everyone who tuned in. One last word, if you like the information that Rob and I provided for you today, please go ahead and subscribe, like, comment, because we'd like to see you again. We'd like to do this again sometime soon. Oh, someone wants to see Dad, Papa. Okay, we're going to have Claude on next time, it looks like.
I spoke to him yesterday and he's like, I'd love to be on. And I said, okay, perfect. Where are you? He's like, I'm in Marchand. I was like, same internet as last time? He goes, yeah. And I go, I can't do that, Dad. So he definitely wants to be on. And the next time we're going to coordinate it so he's in the city and we'll get Claude on because he just knows so much.
Yeah, I think it'd be great to have the three of us for next time. That'll be fantastic. Thanks so much, everyone. Great seeing everyone and having this chat with you. And thanks for all the questions. We'll see you next time.